Dang. Man, I didn't even know that. Oh, hey guys! I didn't even see you there. You caught me at a great time though. I just finished reading a report about the S&P 500 Index Fund. And let me tell you, we've got some really, really great stuff. This report's going to help our analysts seal the deal with our top clients. Did you know that the S&P 500 is made up of 500 highly performing cream of the crop, creme de la creme of the stocks? I didn't even know that. They're traded on both the New York Stock Exchange as well as the NASDAQ. There's over 200 different industries and considered to be a high indicator, a strong indicator of the U.S. economy as a whole. According to our top analysts, this is going to be a slam to our clients. But why believe me? Let's go see what my analysts have to say. Let me introduce my starting five.
Three, two, one. Keep going. Oh shit.
So like I said, I'm going to show you my starting five. Right here I got the analyst room. They're all in here. Working hard, I hope. What's up, fellas? Well, looks like we got three of us. Two of them are out to lunch. I think they lost a bet or something. So they're pretty lazy, but these are my top analysts. Brady, let's see what you worked on with this report.
Oh, hey, Martin. I'm working on the distributions of the net incomes and the rate of return on invested capital for the 500 companies. Okay, Martin. Let's begin our financial analysis by looking at the net income. Net income helps investors determine the strength of a given company by analyzing their revenues after the cost of doing business. It serves as a starting point when determining if a company or an index is an attractive investment. Out of the 500 companies listed in the S&P 500 index, only 496 reported net income. This figure displays a histogram of the 496 reported net incomes from Bloomberg's data service, as well as a comprehensive summary of the descriptive statistics. As we can see, there's a broad range of net incomes, with 9 companies reporting negative net incomes and 471 reporting positive net incomes. The population mean is slightly greater than 1.88 billion, while the median is just above 757 million, indicating that the data is right skewed. The top 3 companies listed in the S&P 500 in terms of net income are, not surprisingly, Apple, ExxonMobil, and Pfizer. If we take a closer look, we see that the majority of companies have less than $10 billion in reported net incomes. So let's look at this a little closer. Here the distribution becomes a bit more normal around the positive net incomes. However, we see that most of the companies listed in the S&P 500 have incomes less than $1 billion. Another measure that is perhaps more important than net income in terms of financial analysis is return on invested capital. Return on invested capital is a key metric that provides greater analytic value than net income. It helps measure the company's efficiency at using its capital and turning it into a profit. Return on invested capital is the weighted return on invested capital and is found by dividing the net operating profit after tax by the invested capital. For this metric, only 407 companies out of the 500 reported an ROIC at the time of this report. The mean was listed at a rate of return of 14.44, with the median at 10.36. Similar to what we saw with net income, the data is again right skewed. A significant portion of the index fell between 0 and 99.9 for a rate of return, while only 8 companies fell below a rate of 0. With most companies distributed around the mean, one company specifically skews the data with their impressive rate of return of over 684. This company is Dun & Bradstreet. The next top 2 companies are Lockheed Martin and Marriott International. Taking the outliers out of view, we can get a closer look and see that a large portion of companies report an ROIC of less than 30, and 335 report an ROIC between 0 and 29.9. Again, there's a right skewed distribution as we've seen with net income and now return on invested capital.
Oh, that's great work you got there going there. By the way, it's Milton. See you next Tuesday. How about you, Grant? What do you got going on for this report of ours?
Well, right now I'm currently looking to see if I can find any relation between the number of women on the board and their financial performance. But currently, let's see what I'm really working at. That's the moneymaker here.
Well, Milton,
First, we have one of the most common and most reliable metrics for valuing and comparing companies' performance, and that is the stock price relative to expected earnings. This metric compares share price to per share earnings. The ratio of prices to earnings is calculated as the market value per share divided by earnings per share. Relatively speaking, a high PE ratio suggests that investors expect higher earnings growth in the future compared to a company with an inferior PE ratio. It is important to keep in mind that different industries have different growth prospects, thus comparing companies across various industries, like those that make up the S&P 500 index, is very difficult to do. Now looking at this data here, we can see that companies listed on the S&P 500 index, there's 98% of them that have a PE greater than 10. 49% of these companies have a PE greater than 20. And the mean price to earnings ratio for the S&P 500 index is 27. These numbers suggest that the index has a strong PE ratio and analysts expect high earnings in the future. Shareholder rate of return is defined as the total return to shareholders from maintaining their investment in a given stock over a period of time. As a potential investor, this metric gives us insight to the possible rate of return expected for each investment opportunity. From the figures shown here, we can see that the index as a whole has a strong potential for meeting very high required rates of return. The S&P 500 has over 82% of companies with a shareholder rate of return of greater than 30%. In total, the mean for all S&P 500 companies on the index is a rate of return of 34%.
That's really good work. That's even better than Brady over there.
All right, how about you, Dan? Besides section and girlfriend, what do you got on our S&P report?
Oh, you know that.
No, actually, I don't know. That's what I'm asking.
The share to the ratio and
That doesn't sound like anything I just read.
How about I just show you?
Perfect.
Oh wait, this isn't even my computer.
Silly rookies.
Oh, wait, here it is. Let me just get logged on here really quick. Ah, isn't she cute? Well, looking at the data, I was able to calculate the average year-end share price, which is 76.112. To better represent this, I used the pivot table to determine the 11 largest industries in the S&P 500 group and display their average year-end share price and how these compare to the overall average. This reiterates the point that the index contains many top companies in a diverse range of industries. This data will also be used to help us calculate market share caps. Net profit to cost ratio displays a company's magnitude of profitability compared to the cost they accrue. Using equal ranged groups, I was able to develop a histogram displaying where the majority of the S&P 500 companies lie in terms of net profit to cost. As you can see, over 450 of 500 companies have a ratio between 1 and 30%. The average net profit to cost ratio is 11.82%. And to better display this, we randomly took 10 companies from that range and charted their ratios. From that chart, you can see that 90% of the companies have a ratio approximately 5% or greater.
Pretty good job. How about you, Monster Mash over here? What do we got going on for our S&P report?
Salutations! As you can see, I'm taking a look at revenue streams and earnings per share. Let's take a closer look.
So Milton, you already know that revenue is the money a company generates by selling its various products and services, and that it doesn't factor in cost structure, taxes, interest, or depreciation. But did you know the average revenue of an S&P 500 company is over $21 billion? That's a whole lot of money, but what do we really know about those companies based on that number? The answer is not too much. While higher revenues are desired by every company, sometimes it can be misleading due to their cost structure, company size, or even industry. While revenue can help us understand the size and performance of an industry, it is important to keep in mind that most industries contain dominant leaders which can skew the outlook of their whole industry. Here's a graph of the top 20 industries by average revenue, as well as the range of companies within them. As you can see, in some industries such as variety stores, petrol refining, and fire and marine insurance, the top performing companies significantly outperform their industry as a whole, in some cases posting returns over 4 times greater than their industry's average. Similarly, bottom performing companies can also skew their industry's data. These are some of the reasons we must be careful when analyzing a company's or an industry's revenue. Earnings per share is shown by net income less dividends divided by the number of shares outstanding. Earnings per share gives us a picture of a company's profitability and plays a huge role in setting its share price. Unfortunately, it doesn't take into account the capital required to generate that profit, and it's relatively easy for managers to manipulate. To better understand this problem, I've taken a look at the top 50 companies in terms of earnings per share, ranging from Apple to Aflac. For the sake of clarity, I've excluded some extreme outliers, Berkshire Hathaway and Dun & Bradstreet, which return values over 10 times greater than their peers. In addition, in Bloomberg's data, some companies do not include ROIC data. Although these companies listed are the best of the best in terms of earnings per share, with a mean of 12.06, compared to just 3.45 for the index as a whole, excluding those 2 previously mentioned companies, their average return on invested capital is merely average at only 14.67. In fact, over half of these companies failed to meet the index's ROIC average of 14.44, indicating that earnings per share should not be used in isolation when determining a company's efficiency in generating profits.
That's pretty good work there, Monster Mash. Keep it up. How about you, Jeremy? Last but not least, what do you got on this report? Well, you see here, I had the market cap, which is split into 3 different things, so there's a lot of work there. And then I also had the debt to EBITDA ratio, and that really, it grinded my gears. It took me a while. But let me show you what I got here. First, Milton, I took a look at the debt to EBITDA ratio. By creating a histogram of the data, I was able to see that the information is skewed right. This happened because the mean of 2.46 was higher than the median of 1.83. For this particular set of data, though, that is a good thing, because a lower ratio shows stronger financial performance for creditors to look at. We also see that there are a few outliers. In fact, 452 of 455 of the companies fall within 3 standard deviations from the mean. Morgan Stanley is the biggest outlier at a ratio of over 37. Next, I took a look at the market capitalization. This is the total dollar amount of the company's outstanding shares. It is calculated by taking the outstanding shares of the company by the current market price of 1 share. I have split the data into 3 parts: small cap, mid cap, and large cap. As you can see, the S&P 500 currently has no small cap companies. In fact, 28% of the companies in the fund are mid cap companies, which are anywhere from $1 billion to $10 billion. The largest category is the large cap. It is anything over $10 billion. 72% of the companies in the index fund are large cap. This helps create the mean of over $34 billion. So this index fund is for our clients that aren't looking for any startup companies. That's all right. We'll take it. Good work.
Yeah, tell me about it.
Then I said 4. It was good work. All right, hey guys. Well, that's all we have for our S&P 500 report. You saw my top 5 analysts and what they did for it, and now we're hoping after the report that our performance skyrockets, because boy, do we need it. I mean, my pay keeps going up, so I'm happy either way. But the company as a whole, we're in the doghouse, so we need this report to really take off for us. So please invest in the S&P 500 index fund.
If you like pina colada.